Fellow risk takers, this is your worst podcast host, Andrew Stotz from A Stotz Academy, and I'm here today continuing my discussion with Larry Swedroe, who is head of finance and economic research at Buckingham Wealth Partners. You can learn more about his story in episode 645. Larry deeply understands the world of academic research about investing, especially risk. Today, we're going to discuss a chapter or two chapters from his book, Investment Mistakes Even Smart Investors Make and How to Avoid Them. Today, we're going to be talking about mistake number 11. Do you let the price paid affect your decision to continue to hold an asset? And mistake number 12, are you subject to the fallacy of the hot streak? Larry, take it away.
Yeah, there's one of the more common mistakes discovered, if you will, or uncovered by behavioral financial economists who combine the field of psychology with investing, is something called the endowment effect. The endowment effect is where we tend to value something more if we own it than if we were to purchase it. So, for example, let's say that somebody, and they've done lots of tests like this, there's a gift that you get that's a Yankee t-shirt, and it's worth, you can go buy it or whatever for $10. But if you own it and you're asked how much would you sell it for, you won't sell it for $10, it would be $15, even though you would never pay $15 to buy it. So we tend to value things more when we own them. So what I try to teach people, the meaning of this endowment effect, is through an example that someone had explained to me. So, Andrew, let's take this as an example. I imagine you like to enjoy a good glass of wine now and then. So let's assume, you've decided somebody has offered you a great opportunity to buy this new wine coming up. It's, all the characteristics look great, and everyone's writing about this year is going to be a fabulous year for Cabernets. And you're offered a chance to buy the Cabernets at $10 a bottle. Now, that's kind of in the price range that you might normally buy for a table wine. You're not going to be able to drink it for a couple of years. So, maybe you might buy bottles $12, $15, and that's your ordinary dinner. 5 years go by, and now that bottle is selling for $200 a bottle. Clearly, it was a great investment, a good decision to buy. The question is, now you have this case, it's ready to drink, and would you drink them? The case, those 12 bottles of wine that you normally only are willing to pay maybe a maximum of $15 for, or would you sell them and get $200 and go buy 12 nice bottles of wine for $15? What would you do, Andrew? What do you think the right answer is from an economic perspective? And what do you think your emotional self would tell you to do?
I think the first thing is that in the beginning, I kind of bought it for drinking, right? So my first reaction is, hey, I should drink this. What's any different about drinking it at this point? But then on the other hand, I look at the price I paid, which was pretty low now relative to the very high price that it's out. And I think to myself, wow, I could make some cash. And so I think I would think about it very differently in that case. And I may take that cash and buy because I can drink a $10 bottle of wine. Not that I drink wine, but that would be kind of my thinking on it. But tell me what you.
And what a lot of people do is they may say, well, I'll keep 1 or 2 bottles to drink, to enjoy it, and then sell the rest, because I would never pay $200 a bottle for a bottle of wine to sit and have every night at dinner with my tuna sandwich or, whatever you happen to be eating for dinner, right? Well, the economic logic is the price you paid for it should be irrelevant to the decision whether you buy or drink it. It should only be, would you pay for that price today, or would you avoid not paying it because it's too much? And in fact, you would make the decision. Since you would never pay $200 a bottle, you should sell all of them. But we have this endowment effect, which causes us to make non-economically rational decisions. All right, so what does that have to do with investing? So Andrew will create an example. Let's say your father worked for General Electric, and it's 1999. Your father happens to pass away, and he leaves you 10,000 shares of GE stock. I'll make something up. It's selling at $100 a share. What should you do with those 100 shares?
I'm gonna appreciate the gift value of those shares and cherish them and hold them for as long as I can, because they were given to me by my father.
Yeah. And he wanted, you knew he wanted you to hold those shares, right? In effect, or at least that's the thing. There's this endowment effect. Now, let's say you had 100 shares, or 1,000 shares of stock trading at 100. It's $100,000. Would you have invested $100,000 in GE stock if your father had gifted you the $100,000 instead of the shares of stock?
There would be thousands of stocks I could look at. Like, right. I would be asking the question, which stock is going to go up over the next, let's say, 5 or 10 years? Which one do I think, if I'm going to put it down on one, do I think is going to have the best opportunity over the next 5 or 10 years? That may or may not be GE, but there's no reason to think that it would be.
Right. Out of the roughly at that time, there were 8,000 stocks, YG, and it turned out GE would have been a horrible investment. The stock has done very poorly over the last couple of decades. Well, another option might have been, hey, if I had the $100,000, I ought to just own a total stock market fund and be much more diversified. But yet many people that I come across, I can't sell that stock. Dad, owned it for 50 years. Dad's not going to hate you. He's gone. He doesn't know whether you're going to own that stock or not. But the endowment effect causes us to put an extra value, either emotionally or otherwise, on it. And we end up making decisions based upon this endowment effect, which is completely irrational from an economic perspective. It may be somewhat rational from a psychological perspective. We're trying to satisfy some psychological need. I love my dad. He wanted me to own the stock. But that has nothing to do with whether your father was smart and, and wanted to tell you on the GE stock, right? Yeah. It may have been that, he said, I got this huge capital gains. I don't want to sell the stock and leave you $100,000. You'll get a step up in basis. In the US, you pay no tax on that. Then you sell it when I gift it to you, and now you can go build a diversified portfolio. But we have this endowment effect. We tend to place value on things that we already own, rather than thinking of them as, if I didn't own it and I had the equivalent amount of cash, would I take that cash and buy that one particular stock? And the answer is obviously almost 100% of the time, you shouldn't own that stock for that reason. So that's a big problem that investors make. They get gifted stock from a parent, a husband, whatever, and then they hold on to this concentrated risk when diversification is the only free lunch in investing.
When I think about the word endowment, I think that someone's given me something, or I've been gifted something. But I guess the endowment effect also applies, just, you could call it ownership, that you own something. There's a couple of things that you made me think of. I have a new client right now that I'm working with. And one of the challenges that he's facing is that it's his father's business. It's been built over decades, but it's a completely different environment now. But he can't close it down, or he can't liquidate parts of it because of that endowment effect, that he just doesn't want to betray what he believes was the interest of his father.
Yeah. So the best advice that I would give is to say, look, there are clearly psychological issues There's an emotional attachment. You loved your father. You want to fulfill his wishes. But there's also an economic rationale that your father, I assume, would want you to do what's in your best economic interest. So here's the question you should ask from a rational economic perspective. And then you could decide later whether there's the psychological value, put a price on it and say, is it worth, keeping this asset that's I could sell for $1 million, but it doesn't make sense to hold, but I do place a psychological value. So the question would be, okay, let's look at what the price you could get for selling it. And if you had the cash instead, let's just make a number up. It's $1 million. If I gave you $1 million, would you invest it in this business? The answer is no. Then the economically rational answer is clearly you should sell it. Now you could decide for other reasons. Hey, look, I love my dad. I know he would have wanted this. I can afford to lose the $1 million. The business goes flat. It's not the end of the world. But on the other hand, what if that $1 million was important? It would allow you to send your kids to have a good education or allow you to retire and sleep well at night. To me, the answer becomes an obvious choice. You have to be able to find a way to separate the psychology and the emotion from the economic rationale.
Yeah, it's interesting because he came to me with his brother, and his brother had a very different opinion of it. Like, dad wouldn't want us just to go down with the ship on this thing. And so you can see the value of an advisor. And this, I want to explain another story that's very similar to what you describe. And that is, my father worked for DuPont all of his life, and he didn't know much about finance, but he knew it was free money coming from DuPont when he could buy a share that was worth 100 in the stock market and he could buy it at 85. So he just loaded up on all of the DuPont stock that he could buy over the last 15 years of his career or so. And that basically gave him a great, return. So my mom and dad retired in North Carolina, and basically they got a financial advisor there. And the financial advisor is the name of it's called Larry Carroll. And that's the firm. And my mom heard Larry Carroll on the news and on the talk shows, and she really liked him. So she said, let's go down and meet him. So basically they started working with him and his team. And what they said is look, 60% of your portfolio or whatever that was at that time is DuPont stock. And they asked, what would happen if DuPont stock went from, let's say, 500 where it was at that moment down to 50? What would happen? What if
it was Enron?
Yeah, exactly. And my dad said, it's impossible.
Right.
And my mom tells the story, and we talk about it. My dad said, it's just impossible. It would go down from 500 to 50. So the guy eventually he convinced them that they need to start selling it. And they started to sell it and diversify that money into a much wider diversified until they got it down, I don't know, maybe 10% of the portfolio. And over time, my dad, didn't feel that attachment as they were selling it. But my mom tells a story that sure enough, after a few years, that share price hit the number that advisor said. In this case, from 500 to 50, or what is my hypothetical, but it was a massive fall. And the advisor had gotten them out of it and diversified that. And so that's a really great example of how you, as an advisor, a financial professional, you can help people get over that endowment effect.
Yeah. Here's another example. This is a perfect example of another mistake covered in my book, which is confusing the familiar with the safe. We tend to think things are safer if we're familiar with them. So we overweight, for example, if you're a US investor, US stocks. If you're a Japanese investor, you overweight Japanese stocks. You're a French investor, you think French stocks are the highest performing and safest investments. And if you lived in St. Louis for most of your life, you thought Anheuser-Busch was a great stock. But if you lived in Atlanta, guess what stock you thought was the safest?
Coca-Cola.
Right. Is it any safer to own Coca-Cola if you live in Atlanta than St. Louis? And is it any safer to own Anheuser-Busch if you lived in St. Louis than Atlanta? It makes no sense. But we do that. So here's a great story to fit yours. I met with an advisory firm that was aligned with our firm in Atlanta. They paid us as a consultant to help them with their clients. And I met with an Intel executive in around 1999. And the guy had the vast majority of his assets in Intel stock. Stock was trading in the mid 60s. The stock, and he was a fairly senior executive. And I said, this is crazy. It makes no sense. You're making these mistakes, confusing the familiar with the safe, concentrating all your risk in one risk basket. And oh no, but I know what's going on. Could not convince him. Within a few years, the stock was at 10. And that was devastating. And I try to point out to him that if he sold the stock in the 60s, his life was secure. He could sleep well. It didn't matter what he could own 20 to 30% equities and sleep well and enjoy the rest of his life. It didn't matter. Couldn't convince him to sell because it could never happen. And if it did happen, he would know.
Yeah, and one of the
later,
great,
he was still holding the stock.
One of the great ways of getting over the endowment effect is, help someone to just sell 5%. Just sell a little bit and let that kind of sink in. And sometimes that can get people, through it. I wanted to say that occasionally, Larry, people ask me about relationship advice, and they mistakenly ask me that because I'm nearly 60 and still single. So, I warn them in advance, about it. But I say, look, I don't know much about relationships. I know my mom and dad had a good one, so I observed that one. But what I will do is just, I only have one question for you, and it's a yes or no answer, and it will resolve all of your confusion. And they say, okay, what's the question? I say, well, you know your boyfriend really well right now, right? Yeah, yep, know him really well. Okay. And you didn't know him when you first met him, right? No, I didn't know him at all. I just thought he was good, whatever. Now, imagine that you didn't know this guy and he walked up to you and wanted to start a relationship. Would you start that relationship with him now? And they say, well, I said, look, just give me a yes or no.
Right.
And they say either yes or no. And I said, there's your answer. If your answer is yes, then you need to double down and invest more time and effort in the relationship to try to make it work. It may not work for various reasons, but if your answer is no, it's time to take action. So
that's a sunk cost. The problem of the not considering some people stay in relationships because I've been with them 5 years. I don't want to have wasted that. The same thing with the stock. You may have bought it 60 and now it's 30. Oh, I got to hold it and at least until I get even. That's a sunk cost. Yep. The only question is, would you buy the stock at 30 today and take that money and buy it? And if the answer is no, then you should get rid of it. That's another common mistake, the fallacy of the sunk cost.
One thing before we go on to the next mistake is just, how do you handle, like when I was looking at the most common mistakes that people were making on my podcast as I'm interviewing people, one of the mistakes is like they're making behavioral mistakes, emotional mistakes, thinking mistakes. And I started like thinking, okay, I could classify this in some way. But man, once you start getting into behavioral mistakes and that type of thing, it's overwhelming. Like you've talked about familiarity, and then there's also recency bias, right? Yeah. And they're not exactly the same. And you just talked about sunk costs, and then there's endowment. And I'm just curious, like, how do you sort through all of or you just have to just know all of these?
Yeah, I wrote the book so people, one, could get a good laugh at themselves. I know I made most of the mistakes. That's how I knew they were mistakes. So the key is education and providing that with people and showing them that what's the logic, giving them an analogy to something that's outside of the world of investing so they can figure out, okay, I get the concept, and then apply that concept to investing. Because once you get the concept, you can then make, hopefully, a rational decision. The information is power, and it allows you to make a better informed, less emotional decision. And that's really where a good advisor or a friend can, play a role by opening somebody's eyes to make sure they're thinking about it in an economically rational way rather than in a psychologically or emotionally satisfying way. The problem is we're human beings and we're subject to all kinds of biases that are hard to avoid. They're ingrained in our system. And, we're not computers. We are emotional. Yeah. So that's one of the biggest values of a good advisor is to educate, show the people the rational economic decision, and let them make then an informed decision. If you want to let your emotions dominate for whatever reason, you place a lot of value and you can accept those risks, then that's fine. You said, I'm willing to pay that price. People buy lottery tickets all the time, although we know the expected return is minus 50%. It's completely irrational. And the sad part is the people who buy the most lottery tickets are the people who can least afford to do it.
Yeah, tragic.
Tragic.
Before we go on to mistake number 12, I just want to tell you about my first and only time that I went into a casino in Las Vegas. And I went to a craps table and I got the dice. And just as I was about to throw it, I yelled, Yahtzee. Okay, I made that up. Anyways, mistake number 12. Are you subject to the fallacy of the hot streak?
Yeah, this is another common fallacy, a problem very related to recency bias, which we have discussed in the past, where we place an overwhelming amount of value on what has happened recently. So a hot streak. So for example, LeBron James, let's just say he's a career 50% shooter overall. But LeBron James has hit 5 shots in a row. Okay. So people are willing to bet, boy, he's hot. He's going to make the next one. Turns out studies have been done. Career 50% shooters shoot 50% on the next shot, regardless of whether they've missed their previous 10 or made their previous 10. That's a great example.
Are you sure?
Yeah, that's the data. We can look at the empirical evidence, not the theory. Now, in the short term, it might be somebody is hot because he's got a lousy defender and no one can guard him, or he's being, guarded by a superior defender, and it's a little tougher. But on average, there is no such thing as a hot streak. A team that wins 70% of the games is, after losing 3 in a row, is just as likely as a 70% chance that they will win the next game. And so we unfortunately place too much evidence, particularly on investment managers or stocks or whatever is on that hot streak. So the example that I use to help people is the story of a mathematics professor who is teaching a class in statistics. And he comes into the class and he tells this class of 100 kids, it's a lecture hall class, says, I want everybody in this room to write down T or H, heads or tails, imagining that they're flipping a coin. And write out the 100 number, the T's or the H's. And I'm going to leave one coin on the desk, and I want one student to pick it up and actually flip the coin. Okay. And I'm going to come back in 30 minutes or whatever. And I will identify, I'm going to, in the next class when we hold it, I will tell you which student flipped the real coin. So everybody's going to sign their name. Just don't put whether you flip the imaginary coin, right? Or you flip the real coin. And the large majority of the time, the professor was able to identify which person flipped the real coin. So how do you think he did that, Andrew? How could he figure out of 100 students which one is flipping the real coin and which one is flipping the imaginary coin and writing down that T and the H.
Well, this goes to the issue of how they find tax cheats sometimes by looking at the final digits of numbers that they submit, that they're not randomly selecting them.
Yeah, that's right.
In that case, you would say that they may expect a hot streak through in the heads or tails that they're putting down, when in reality it may just be randomly up and down. But
so how does the professor find the person who's got the hot, who actually flipped the real coin? What is he looking for?
He's looking for well, the first thing I would say is that you're going to have streaks that naturally occur.
Right.
And so, and students
just stop right there, because that's the answer.
Yep.
Right. When we flip an imaginary coin, we don't think there'll be more than maybe 3 or 4 heads or tails in a row. So, but the fact of the matter is, the odds are pretty good that somewhere in a flipping of 100, you'll get 6 or 7 heads or tails in a row. So he just looks for the person who had the longest streak of 6 or, whatever, the most heads or tails in a row. And he predicts that person is the one with the real coin flip. And it turns out that he was right most of the time. That's the problem. It's very hard to distinguish luck from skill. So, for example, if you have 10,000 money managers, which is about how many mutual funds we have, what are the odds randomly that you would expect, even if the markets were perfectly efficient, what are the odds that somebody could, before costs anyway, right, could outperform the market? It's about 50%, right? So 5,000. At the end of 2 years, you would expect randomly 2,500, 3 years, 1,250, 4 years, 625, 5 years, 312, and on and on. After 10 years, you might expect that randomly you'd have 10 people who would have flipped those 10 heads in a row. That's the equivalent of beating the S&P 10 years in a row. Now, would you put your money on someone winning the next round of flipping coins, saying heads wins every time?
Of course I would, because I just saw in the news that this guy flipped 10 times in a row, and I just wrote a book, How I Flipped 10 Times in a Row. How could I not believe that?
Right. So that's the problem. It's very hard to distinguish luck from skill when you have large databases and so many people competing. You need huge amounts of data to do that, and we confuse skill with luck often. And so that's what leads us to this fallacy of a hot streak. You have to do statistical tests to see, did we have more than randomly we would have expected active managers, for example, outperforming the S&P? So, for example, over a 20-year period, you would expect 2% to outperform just randomly. So if the actual number is 1%, then we know that fewer outperformed than randomly expected. So we shouldn't attach any value to the ones who did. If we got a lot more outperformed than randomly expected, maybe then we have a clue to help us identify what traits did those outperformers have that was consistent and different than the ones who underperformed. No one has yet figured that one out, unfortunately, or fortunately, and therefore we have no way to identify who are the future winners, and we cannot rely on past performance.
And those darn losers study the winners to say, how did they do it? And all of a sudden you get a self-correcting mechanism in the market.
To some degree, you get that, but actually what happens is this. More likely, the outcome is this. Let's say you have 5,000 winners after 1 year and 1,250 after 3. So people wait 3 years. They see these 1,250 really bad managers who've just, or the not 1250, the other 8,700, whatever the number is, right? So we kick them out. If we had money with them, we sell and we put the money with some of those 1,250 winners. So now what's happened is some of those losers, those 8,875 losers, some of them had skill, but never got a chance. They just had bad luck randomly over a 3-year period. Maybe their investment strategy was out of style or whatever. But they never got a chance. So money flows out and they have to shut down their funds. Now, the remaining people were either skillful or lucky, right? Let's say half of them had skill, half had luck. The next round, the ones who were lucky are going to disappear, which means over time, the competition is getting tougher and tougher because only the skillful are remaining, which makes it harder and harder to outperform. And that's why, as we explained in my book, The Incredible Shrinking Alpha, successful active management is a loser's game anyway, because if you win, you get a lot more dollars. And now you either have to diversify more. So now you look more like the market and it's very hard to outperform, or you have huge market impact costs because every time you're trading these small number of stocks in illiquid markets, your trading costs go up. So they tend to fall off because of their own success, unless they cap maybe at, depending on the fund, maybe at 1 billion if it's small cap, or 5 or 10 billion at large cap. Unless they actually cap their assets under management, they'll fail because success breeds the seeds of its own destruction. Because most of them will not turn down the chance to earn fees on the bigger assets. Very few will shut down taking new money.
Except for one of my guests, Richard Lawrence, who has the fund called Overlook in Hong Kong. And what he basically did is set limits of how much he would take in from the clients at peaks and at bottoms also, with the idea being that he tried to keep his fund at a certain size, knowing that in the end, that would be, the best.
The rare active manager who is thinking in the interests or the best interests of his clients. They're rare. They do exist, but there aren't many of them.
And his book is somewhere. I've misplaced it, but he's written a book that's really great about explaining that. And just let me check one thing on this. And also, while I'm looking for that, I just wanted to mention that there was a story I saw on the internet that I want to go through about this. In August 1913, can barely remember that day, but that month. But in August 1913, a group of gamblers lost a ton of money betting in the Monte Carlo casino. They watched as the roulette ball kept falling on black, which it did 26 times in a row.
Whoa.
That is a 1 in 66 million chance outcome. The gamblers kept losing as they bet that the longer the black streak went, the higher the probability of breaking and landing on red.
But that's wrong. It's still 50, or a little less than 50%, because you have the 0 and the 0, it's like 48% or whatever the number is, right? Each time it's a random event. It's a mistake.
Yep. And it's the gambler's fallacy, or also called the Monte Carlo fallacy. And it's when you believe that past or most recent outcomes, rather than randomness, drives the next outcome of a random process. And that's really what we're all about in this.
Yeah, my favorite story about this hot streak is about David Baker, who ran a fund called 44 Wall Street. Now, if I asked you who was the best, most famous money manager of the 70s, only one name should come to mind running mutual funds.
Peter Lynch?
Peter Lynch. But Peter Lynch was not the best manager in that period. He was only second best. Now, Andrew, why would you give your money to the second best manager when you can give it to the number one manager? So David Baker's 44 Wall Street, the next decade, when Lynch went on to continue to have strong returns, David Baker's 44 Wall Street, while the stock market was soaring, every dollar invested turned into 27 cents, losing 73% of its value. There's the best example I know of the fallacy of the hot streak. How can 10 years be locked at how to be skilled? It's noise when you have so many people playing the game.
Yep. And for the audience, episode 687 is Richard Lawrence's episode. And the title of it is Avoid the Stock That's the Hype of the Day. And his book is called The Model, which I have on the other side of my bookshelf over there. It's a great book where it describes his methodology of what he did over the years. So gives you some idea. Anything you want to add to this discussion before we wrap up, Larry?
The only thing I would add is relevancy to today, using Richard Lawrence's analogy. The hot stocks are the AI stocks. Not all of them can be super winners, but they're priced as if each and every one of them will go on to be a winner, yet maybe one or two of them will actually dominate and the rest will go bankrupt or disappear or provide mediocre returns. So you want to avoid FOMO, this fear of missing out. Just build a diversified portfolio, avoid picking individual stocks. That has far more to do with speculation than it does with investing.
Great advice, Larry. I want to thank you for another great discussion about creating, growing, and protecting our wealth. For listeners out there who want to keep up with all that Larry is doing, find him on Twitter at Larry Swedroe and at LinkedIn. This is your worst podcast host, Andrew Stotz, saying, I'll see you on the upside.